What's up, guys? Thank you for tuning in to my first episode of my show, podcast, whatever you guys want to call it. I don't really have a name for it myself yet, but the whole intent of it is to give you guys solid information. So, for anyone who's a young professional looking to invest, whether it be in real estate, stocks, money markets, bonds, crypto, the intent for this is create a space where we can come and we can discuss ways to drive our financial freedom, right? So my name is Cameron. I specialize in real estate. We're gonna be doing a lot of talk about real estate. So today I've got my guy, Micah James, with me. He and I go way, way, way back. I'll let him tell you a little bit about kind of his accolades, but he's a mortgage banker. So today's gonna be focused specifically on talking about home ownership and what steps you need to take as a young professional in order to get to that point, right? So, Micah?
Thank you for having me, Cam.
Yeah, man.
Appreciate it, man.
Absolutely.
Appreciate it. I wanted to shout out real quick my company, Western Ohio Mortgage
Yeah,
Corporation. You know, just whoop whoop to them.
Mm-hmm. Absolutely. You want to tell them kind of what got you into the business? Well, first, tell them how we know each other. That's my story.
So it's kind of combined, actually, right? So I went to school, got out of college, got my first job at a place called Arch Wireless, and I worked my way up from the telemarketing division all the way up into being a manager. Like I was a sales manager. We did business to business sales for pagers, right? The ones that you would like clip on. Yeah, you've probably never seen one. Anyway,
I've seen them in movies.
okay. So eventually we got to the point where we had the flip up ones where you could like type on them and send messages to each other, right?
So a cell phone without calling, basically.
Yes, because I mean it was basically the precursor to text messaging.
Okay. Yeah.
Right. So anyway, there was this bank that would not upgrade for some reason, and one of my sales reps he had gone there like 4 different times and couldn't get him to do it. So I was like, you know what? I'll roll with you. Let's get this knocked out. We'll get him to upgrade. And the senior vice president there, he was just obstinate, but we had really good conversation. We connected. And so about 40 minutes into the conversation, he asked my sales rep to step out and he offers me a job. Yeah, offers me a job as a loan officer at a bank. And again, I had put in all this work, 5 years at this company, working my way up into management. I had no intention of throwing that all away to start over in this industry.
And how old are you at this time?
I was about 25.
So 25 and a sales manager. Okay.
Yeah.
So you're doing your thing at this point in time. Okay.
This is
Yeah.
what I'm saying. Like I thought I had a great career.
Right.
Like I was going to the top, but you know, during that time period, it was the early 2000s. It kind of became obvious that, at least to myself and some of my colleagues, that cell phones were going to take over. You know, pagers weren't going to be. You remember the Nokia,
Yeah.
right? So the Nokia,
Talking about the brick one.
little brick,
Play Snake on it.
yeah,
Yep. I
and
know
then
exactly.
and then they had other phones that could do walkie talkies and all that stuff. So it was like, you know, the technology was changing, but my company wasn't trying to advance. They were just like, nope, pagers is the world. There will always be pagers. There will never be a time when there's not these, you know, special pagers for people.
And in entrepreneurship and business, if you're not moving forward, you're dying.
Exactly,
that's
exactly. And
like, yeah.
and myself and a lot of the other young people that were there could all see it. And so, you know, like in any corporation, eventually, you know, they made some changes, but they weren't making any changes to move forward. So I decided to go back to the senior vice president at this bank and say, "What's up? You know, what would this look like?" And he told me, he said, "You'll be wildly more successful in this industry than you will be, you know, pushing pagers." And he said, on top of that, you'll actually be helping people to accomplish their dreams. He says, I can tell the kind of guy you are. That will mean more to you than any money you make in this other business.
Right.
So the guy's name was Jeff Dillman. He was a great guy, my mentor. But he convinced me that it made sense to completely throw away the plans that I had for my career and start over in the mortgage industry.
So that was 20 plus years ago.
Correct.
What would you say the reason that you're still in this industry is 20 plus years later?
Just
you
what
don't
he
see that
said.
often. In today's job market, people are jumping jobs, jumping industries, whatever, you know, wherever the next opportunity, the next best opportunity. Why would you say that you stuck in the mortgage industry for so long?
I would say it grabbed me.
Okay.
It grabbed me. It made me stay. I mean, Jeff was completely right. Like seeing people have their life changed was so big for me. you know. And then on top of that, again, I told you I'm a 25-year-old black kid, right? And if you know anything about this industry, there's not a whole lot of people that look like me in it,
Right.
right?
Yeah.
Whether it's on the real estate side, the mortgage side, there's not a lot of us.
Mm-hmm.
And so it's like, how am I going to get people to work with me, to help me to be successful in this business? Somebody has to give me a shot. That's where your grandfather came in.
Yep.
Right?
Okay.
So your grandfather was already an OG. Gunnels Realty had already been around for a long time.
Uh-huh.
It was well known. And one day he came into the bank because he had another closing that he was going to. And he saw me, right? Had never met me before, right? But he sees me in the lobby and he's like, "Hey, young man, how you doing?" And I'm like, how you doing, sir? I was like, "You're Mr. Gunnels, right?" He was like, "Yeah, I am." He was like, "So are you doing well here?" And I'm like, "I just started not too long ago. So I'm trying to make my way in this business." And he said, "You know what? I tell you what, I got a couple clients that I'm gonna let you work on." Now again, I could have been terrible at this for all he knew, but he saw a guy that looked like him trying to make something of himself and gave me an opportunity. And I did a really good job with them.
Ran with it.
Yeah. And next thing you know, 20 years later, I've done business with so many members of your family,
Literally.
it's,
Yeah.
it's like that's just been one part of it. So he and people like that helped me, and it completely changed my life. Like I have so much more financial freedom, so much more opportunity than I think I ever would have staying in that corporate job that I have. Arch Wireless is not even in existence anymore. Like I was completely right. They didn't make it. Cell phones took over.
One win for the good guys.
Right. I remember the first time off camera I told you about these two-way pagers, and the way your face looked, it's like I felt like I was so ancient.
I've seen them. I've seen them in TV shows and stuff like
Right,
that.
okay,
Yeah.
all right.
But I did think that the pager had to take you to a payphone.
Right.
And then you had to call the number
Right.
on the payphone.
Right.
But that's not
That's
what
the
you were
part
selling.
that made me feel
Yeah.
ancient.
Yeah. That's
yes.
okay. Gotcha.
Yes. Because anytime we start talking payphones, it's like, come on, bro. Yeah.
Okay. So I guess moving forward, what considering that you're in the mortgage industry, you've been here for so long, you like helping people. Why is home ownership so important?
It is important because it is the biggest asset that the majority of Americans have. Okay. The richest people in the entire world all have a big part of their portfolio that is real estate. There's a reason for that. It's because it's basically recession proof. Um, I always tell people that having a home is like it's either you either have positive appreciation or assured mass destruction.
Mutual destruction.
Yeah, because if the mortgage and real estate industry actually collapsed, that would mean America collapsed. Right? So you're buying into America when you buy a house.
That's
You're buying into the full faith and credit of the United States government. You're getting a loan, you're owning this property that they say is yours, and again, it's either total appreciation, mutual destruction, one or the other.
And another thing that actually my grandpa always told my dad, and my dad started telling me, is that everything is supply and demand, right?
Yeah.
So everything is how much there is and how many people need it.
Yep.
Land is the one thing they're not making any more of.
They
and
are
there's
not.
always going to be more people. So there's always going to be an increasing demand, but a limiting supply, right? Especially with global warming, right? So there's less land mass than there ever was before. So that's also something to think about.
It's also recession proof.
Yeah, yeah.
Recession proof.
Yeah.
Because, you and I weren't alive during the Great Depression, despite how you joke about me. But
You might have.
I was around in 2008, the last time that there was this big turn down. Right? And in 2008, for the first time in probably 60 years, people lost value in their house. It's like I bought my house at 200,000, and now it's being appraised at 175,000, and people were freaking out. They were walking away from their houses. They were selling them at a loss just because, oh my goodness, everything is about to go berserk. But do you know what happened? The majority of people did nothing. They just lived in their house, kept going on every day. By 2012, the mortgage industry, the real estate industry had all come back. all those people that had a $200,000 house, the house is now worth 250, and then it kept going up and up and up and up
It
again.
surpassed levels before 2008.
Oh, well past.
Yeah.
Well past.
Yeah.
So if you're trying to have something that is recession proof, stocks aren't recession proof. There's nothing else that you can invest in that's recession proof. Somebody's always going to want your house. I mean, assuming you take care of it.
So if you were to compare home ownership versus renting,
Yes.
what does that comparison look like? That side by side.
Okay.
Because and I want to put some context to that, because a lot of the people in the circles I run with, we're all of the same, 25 plus, 20 between let's say between 23 and 33, young professionals, to the point to where you're either you're living in a cool apartment downtown, or you're spending a lot of money on rent, or you don't know where you're going to settle down at. You don't know if Cincinnati is going to be where you live forever, or whatever city you're in, it's going to be where you live. What, I guess, if you had to put the two next to each other, what would you say the pros and cons are, vice versa?
So we talked about security with the house, right? So there's security, there's appreciation, there's tax write-offs, all that good stuff. With rent, really you get the enjoyment of where you live right now.
Yeah.
That's basically what you get.
The community pool.
Yeah, and your generation, man. I mean, when I got my first apartment, it was it was $450 a month. My first apartment.
Oh man.
$450.
What?
Right. $450.
How many bedrooms?
One.
Even still.
One, but it had a fireplace.
Like a real one?
Yeah, like
Okay.
it had a fireplace. It was a nice apartment, and $450 a month, and I'm thinking that I am doing it. Guys your age are paying $1,300, $2,000, $2,500 a month for apartments, right? As soon as they wanted to bump my rent up to $600 after I'd been there a couple years, I was like, it's time to get a house.
Right.
Like, oh man, I'm just wasting my money. But now people think completely different. So let me answer your question. All right, so we have an apartment where you pay your monthly rent. The benefit to the apartment is that you just don't have to worry about maintenance. You don't have to take care of the place. If something breaks, you just call somebody. If you want to move after your lease is up, you can just do it. It's not a problem.
No strings attached.
No, no strings attached. It's basically the difference between having a girlfriend and being married. That's basically what it is. Apartment is your girlfriend.
Yeah.
House is your wife.
Okay.
You're married to it. It's like if something breaks down, you got to fix it. You got to work it out. It's more difficult. And, things do happen with houses. Everybody who's owned one has had, a water heater to go out, have to buy new appliances, roof might go bad. All those things are there. So a lot of times people are like, I'd rather just,
It's attention. It's brain space.
Yeah.
Yeah. Okay.
Yeah. But you're not married yet.
Right.
Right. So you'll see what I'm talking about. It's like a relationship of marriage takes a lot more work and maintenance than a relationship of just being boyfriend and girlfriend.
Yeah.
Right. Because things don't go well. You just, I'm out. I'm done.
I know who to come to for relationship advice. Okay, but I got you.
But,
Okay, cool. So then, I guess if you flip that,
Yes.
where we already kind of talked about some of the benefits of home ownership.
Yes.
But I guess one more thing I did want to bring out is that a lot of people just they don't necessarily understand the process of home ownership, right?
Yeah.
So obviously there's you might not want to deal with the overhead maintenance of it, but there's also the selection of people who they would love to own a home, they can afford it. They just don't really understand or don't know what that process looks like step by step. So that's something I wanted to walk through with you in a little bit.
Okay.
But when we go back to the benefits of actually owning a home, let's talk like the net worth and general financial advantage of owning a home. And
Okay.
some of the doors that opens up to you financially.
Okay.
Because I definitely want to put everybody in a place to where they're able to understand the stair steps that you can take to building that financial freedom. So when you're 35, you're chilling, right?
Right.
That's our goal. So
I got
if you could speak on that a little bit, because I know you and I had some good conversations off camera.
So basically, when you're buying a house, you're building equity.
Okay.
That's where your real asset comes from.
Yep.
Okay. So yes, you get to live in your house every month, but you're paying down your balance on your mortgage every month. So it's kind of a forced savings account. That's the secret of a house. It's like every month that you pay that mortgage, the balance comes down. So an example that I wanted to give you was that if you were to take a house that you buy for $100,000, now of course I'm not saying you could do that now, but let's say you bought a
For the sake of
house.
the conversation,
Yes,
hundred
because
thousand
I
dollars.
just like a nice round number.
Yep, yep.
$100,000, you put down 10%. You put down $10,000.
Okay.
You have a $90,000 mortgage.
Yes.
Right. All right. So over the next 10 years, you pay on that mortgage, and let's say you bring that balance down to $60,000. Right. You got a $60,000 balance. You bought the house at 100. Right. So that's $40,000 worth of equity right there.
Mm-hmm.
But over those 10 years, your house actually grew in value also. So now instead of being worth 100,000, it's worth 140,000. So you have $80,000 of equity in there.
Mm-hmm.
Now, what can you do with that?
That's the question. That right there. Okay, go ahead.
What can you do with it? You know, you can get an equity line that's tied to your house,
Mm-hmm.
and you can make improvements on your house. You can use it to buy other properties. You can use it to invest. All of those things are options that you have because you own that house. What do you do with apartments?
Pay your rent.
That's it. You don't get any of that.
And what happens to that money that you're paying? It disappears.
It goes towards the equity of the landlord.
Oh man, there you go. Yep.
That's where that goes.
Yep.
That's where that goes.
So I guess the big point to this, and I'm gonna look at that camera. I guess the big point to this is that when you're renting, everything that you pay on a month to month basis for your personal finances just vanishes, right? When you own something, everything that you pay on a month to month basis goes into this, I guess, magical bucket that you can call equity. And what you can do is you can pull out of that a certain percentage, and you can use that either to, as we mentioned, doing home improvements, or you can use that to go reinvest it, depending on what your risk tolerance is. Or you can also use that to go, if you have a sudden life emergency that happens. So it creates a security and this kind of buffer to where you're never going to be in a situation where you just truly have no way of getting capital. And that's our goal. We want to create cushions in every aspect of our life. We want to hedge against risk, right? So it's all about risk hedging. Going forward, with that being said, like you mentioned earlier, you also have the way that the market increases, right?
Yes.
So it's almost like with that magical bucket, it's like I guess the best way to put it would be a line of credit that doesn't have a ceiling. So it just keeps increasing the longer that you own it, right? So while your house might be worth 100,000, then it's worth 150,000, 160. That equity that you have keeps growing, and that's where we circle into the time in the market talk. So why buy now versus wait 10, 15 years? Why buy now when you say, oh, I don't have a wife, I don't have a girlfriend, I don't have a dog. Why would I own a property? And then that's kind of I know when I was talking to you, you had some good examples as to that as well.
So let me just ask you this: you go to a grocery store.
Yep.
If you were to go to the grocery store and you were to buy milk, and milk today was $3 a gallon, would you buy the milk? Or would you say, you know what, I'm going to wait till next week to buy the milk?
I don't know. How much is milk usually $3 a gallon? I just kind of, if I need milk, I just
The first
buy it.
thing you got to do, right. But see, that's what happens with people. People don't even know how much things cost, right? So you're going in there, you're just like, I don't know. I don't make a decision. All right. So that's one of the reasons that you have a professional, right? So I come in, I say, hey, Cam, all right. So milk today is $3 a gallon, but every week milk has gone up 25 cents. Now, you're going to the store. Milk is $3 today. Would you buy the milk?
Yes.
Why?
Because I'm saving 25 cents.
There you go. So 2 weeks from now, that milk will be $3.50, right? The same thing happens to a house. The moment you buy it, it's not going to just stop appreciating when you buy it. It keeps on going. So the earlier you buy it, the more money you make. All right. So the same thing. I know we're using this milk example, right? But let's say that you were to buy the milk at $3 and then you waited 3 weeks, right? When you sell the milk, it's going to be worth more than what you bought it at.
Yeah.
Okay. That's how a house works. It's like, even if you're going to own it for a short period of time, during that short period of time, the value went up. Okay. So you're like, hey, I'm a professional. I got moved into, this city to do a job. I'm only going to be here for 3 years. I don't think I should buy a house. I should just rent. No, that's 3 years of appreciation that you're throwing away. No, take that appreciation. And after the 3 years, You can sell the house, take your earnings, or you can rent the house out.
And the biggest rebuttal that you're going to get to that is, well, appreciation isn't guaranteed.
Right.
And so then you get back into, we are circling back to what we talked about earlier, that 2008 conversation. Yeah, you might take a L for a year, 2 years, but in real estate, in stocks, in crypto, gains are never gains until they're realized, right? And when I say realized, I mean until you actually sell.
Right.
So you never really accept a loss until you sell. You never accept a win until you sell. So you're really not losing money until you say, I'm going to put this on the market and sell it, right? So
Man, let me tell you something. So just talking stocks for a 2nd, right? Amazon is down to $90 a share, right? Amazon stock.
really,
Right. Yeah. It's down to like $90. And it's been, probably at least double that for a long time. But, because of what's happening in the economy, everybody going back to work and not just sitting at home buying stuff all the time, it has come back down a bit. So the question is, are you going to stop buying stuff from Amazon?
no,
You're not, are you?
nope,
Can you ever see a time when you're not going to buy stuff from Amazon?
not right now.
Right. Unless something better comes along, Amazon is probably going to be there.
Yeah.
So if you bought your stock in Amazon and it was worth $160, and then Amazon stock dropped to 90 and you sold, you lost money. But if you were like, you know what, people are not going to stop using Amazon, I'm just going to hold on to it. Eventually, Amazon will probably rebound and go well past the 160. It's the same thing. What your example where you said that you don't realize your gains or losses until you sell, the house is the perfect example of that.
And one more thing I want to speak on renting, and then I want to transition kind of into the process of what it looks like to purchase a house.
Okay.
One thing I want to say about that is, as every year rents go up because landlords have to be able to sustain their increasing insurance and their increasing tax, and inflation goes up. So every year rents grow at least at the 10% of the rate of inflation, right? So with that being said, every year you're paying more and more and more into rent. So you have a variable expense. That's probably your biggest expense. So it might be $1,500, $1,600, etc. When you have a mortgage, hopefully you're getting into a 15 or 30-year fixed, and that's a fixed expense for the length of the term. So hey, I'm going to pay $1,500 a month or $1,300 a month for the next 30 years. Whereas when you're renting, you could have started, year one at $1,300 a month, and then year 6 you're at $2,100 a month. You really don't know that, right? So that's a big point to point out too, is that when you purchase, you have a fixed largest expense, and then when you rent, your largest expense is variable, and that matters.
And some people would say to you, well, you do have taxes and insurance on your house, but that's not a big part of your expense. That's probably less than 10% of your total housing expense when you're talking about tax and insurance. So those can vary a little bit. The rent, as you just pointed out, it varies depending on what market rent does.
Literally.
And you could have an apartment and you can be happy with it, and also your landlord can sell the building.
Then what?
You have to move. You have to move. It's like if they don't, if the new landlord comes in and they want other people in and they want them to pay higher, like usually they find ways to get you out of there. So you have no control over that. Somebody else is in control of your life. And one other thing that I don't think people realize is that when you're renting, you get zero credit for that on your credit report.
Say that again.
When you are renting, you get zero credit for that on your credit report versus a mortgage. Every month you make that mortgage payment, your credit score goes up. But as far as rent, the only time that they get reported on a credit report is when you don't pay. That is it. So people don't realize that, but yeah, you usually can get an even better credit score by owning a house.
And to build credit, you have to use credit.
You have to use credit.
So you might be in a situation where really, you don't have a credit card. You come out of college, you get an apartment, you're renting, you think you're building credit. You're not building credit at all that entire time. And then when it's time to buy a house, you don't have any credit.
You have no credit. Yeah. You still need a cosigner.
Yeah.
But I don't want to say renting is completely bad, because like I told you when we were talking before, we need renters out there. Those of us who own rental properties, we need somebody to rent them.
Mm-hmm.
I only eat organic food, but I do realize that people still love fast food. So I invest in those companies also. I diversify,
Mm-hmm.
and people like you and others who own rental property, if everybody was like, hey, I'm just buying houses, where would you be?
I still don't understand why you have McDonald's stock and not like Chick-fil-A or
I have
Five
I have them
Guys
all
or I
because
mean,
because I don't know exactly what people like all the time, and you young people, it changes. It could be Popeyes today,
I mean
and
that spicy chicken. It had a run, a little spicy
right,
chicken sandwich.
right. But you guys eat all that different stuff, so
Yeah.
I invest in that. Like I'm also invested in Whole Foods. That's where I eat.
Okay.
That's where I get my food from.
Mm-hmm.
But it's like no, no, no. I understand choice. It's like whatever everybody likes, that's what they should have.
Absolutely, absolutely, and it's also about the time in your life you're in too. So,
Yes.
but okay, so let's assume kind of a transition. Let's assume that someone is ready to purchase a house.
Okay.
What are their first steps? What do they do?
Number one is pre-approval.
Okay.
So that means that they come to someone like me and we look at their credit, their income slash debt ratios, and also their assets to see if they have money to put down. When I'm excuse me, when I'm talking about debt ratios, that's something that people don't understand. So I'm just going to explain that just briefly.
Okay.
Debt ratio is the amount of debt that you have divided into your gross monthly income. Okay. So we take all your credit cards, your car payments, your student loans, then we add a house onto that, and then we divide it into your gross monthly income.
Okay.
That's how we come up with a debt ratio.
Yep.
So basically, we're trying to determine what we think you can afford.
That's a difference too, which we'll talk about later. What
Yes.
the bank thinks you can afford versus what is smart for you.
Yes.
To afford.
Correct. And so that's what we're trying to come up with. Can they afford it? Does their credit say that they are a trustworthy person? Something else people don't know about. That's basically what a credit report is. It's basically us getting a report from somebody to say how likely is this guy to pay me back, right?
Mm-hmm.
Credit scores right now go from 350 to 850, right? So if you have a 700 credit score, basically we think there's a 70% chance you'll pay us back.
That math doesn't really work out, but
no, I mean
if it's 850, if 850 is the highest.
No, but I said 700 credit score.
Oh, okay, gotcha. Okay.
700 credit score
Mhm.
means there's a 70% chance. 850 is the highest. Why? I always thought that. Why is 850 the highest? Because that 15% allows for time and unforeseen occurrences. Because that can happen to anybody. You could want to pay your bills, but you could lose your job and not be able to.
That's the gap between. Okay, okay.
Right. So there's a 15% variance
I did not know
for
that.
any
So I'm
person. Yeah.
Interesting.
So here you are. At most, you're 85% likely to pay us back at best. Right. But as your score goes down, that's why when you start to get into the 500s, you get less people trying to do loans for you because this is a 50-50 chance of me getting my money back. And if you're lending your own money,
Nope.
I didn't even get to finish the question. That's what I'm saying, though. But yeah, that's exactly it. You want somebody to get your money that's going to pay it back. That's basically all that banks and mortgage companies are doing. We are trying to prove that you can pay us back.
So what boxes are you checking when you're looking at that? So obviously you're looking at credit score. That's one box. What else?
The income.
Income. Okay.
Income. And then the other thing is your assets. Okay. So, and when I say assets, like a young person might not have a lot of cash and stuff built up at that point, right? But basically, what I can see by looking in your bank account, are you saving your money? I've had people that by the time that they pay their rent and all their expenses, there's $100 left at the end of the month. That's a problem. Now, I will tell you that a closer look at that bank statement usually means that like they're going to Vegas every couple of weeks or on vacation all the time with their friends, living their best social media life or whatever, because some of these people like make really good money and just like only have $100 left at the end of the month. It's like something's not adding up.
Right.
We need to call your parents.
Right. Okay. Then what?
So after we figure all that out, we come up with a number. And it's like, all right, this is the number that you can afford as far as your house. So now It's about what type of loan that we're going to do.
Okay.
Now, there's several different types of loans, but the majority of people do either a conventional loan or an FHA loan. That's the majority of people.
Difference. So because that's something I hear a lot. I
Yes.
hear a lot of people are scared of FHA because they can afford a conventional, or vice versa. Other people are trying to go the investment route, so they are FHA minded. Can you kind of create the difference for us?
So,
And also, if you don't mind, can you also go into why, like, so the general, here's the difference between the two, and then why, which situation each person would want to use one.
well, generally, an FHA loan historically has required a lower down payment.
Okay.
That's number one. They also allow lower credit scores.
Okay.
Okay. And it is federally backed by the government. So the government just straight makes all the rules on it. They insure it, and it's a good product for most people. A lot of them also come with like first time home buyer programs. So if you haven't had a chance to save a lot of money, a lot of times you can get special programs so that you can get your down payment paid if you qualify for it. So FHA in itself is a good product. I have nothing against FHA. I think it actually gets a bad rap. A lot of people that are using that loan are not necessarily what people think in their mind. They think in their mind that like FHA people are like lower class, like, oh man, these are just people with lower credit scores who haven't done a good job taking care of their life situation, yada, yada, yada. It's not. A lot of people are just coming out of school. They haven't had a chance to build a lot of credit, and they have a good job now, and they just, I've only been making money for a year. I haven't had a chance to save $20,000. So a lot of those are the people that I see doing FHA loans these days.
So if you were to cycle that into conventional.
So conventional is basically you have a decent sized down payment. Now, majority of people who do conventional loans now can do them with as little as 5% down. The majority of people who do conventional loans right now do them with as little as 5% down. Okay. But there are some situations, like if you're a lower income, like sometimes you'll be able to do it with 3%. But most of the time it's 5% down.
You didn't tell me about the 3%, man.
Well, the type of property that you buy also factors in.
Yeah, that's true.
Okay,
that's
so
true. I'm buying a lot of investment properties. Yeah,
right, right. So it's not like you can just do it on anything, and you can't do it on multifamilies. So that's the main thing. Then usually you have to have a higher credit score, like kind of a base that we look at is like 700 or above.
Okay.
Right. So if you're a 700 above credit score, we're usually looking at you for conventional first. Right. And then conventional, the loan is just a bit cheaper, a little bit. As time has gone on, they've kind of started to even out. But the conventional loan is a little bit cheaper. There's a little bit less that goes into the inspection by the appraiser when they go out to see the house. But to be honest with you, I feel like conventional and FHA loans, as they've adjusted over time, are very similar now. FHA is actually in some situations just a better financial tool. I have some people who have 700 credit scores that just because of their situation choose to do an FHA loan.
Yeah. So it really comes down to that conversation that you have with your mortgage banker.
Yes.
That's what matters.
Yes.
And that also takes me into the conversation of who you choose to be your mortgage banker and your realtor. You want to work with someone that's within your personal network. So I would even go back to what you said, like the first step would be. I would even go back to change that to, I think the first step should be reaching out to your personal network. Reaching out to someone that that just bought a home, or if you have a realtor that's in your personal network or a mortgage banker that's in your personal network, reach out to them first. And then once you do that, work with, so for example, you want to buy a house, instead of going online and calling the realtor that's on the listing online, instead of doing that, reach out to someone in your network, go start looking at houses, and then work with the mortgage banker that they recommend. Because this is the biggest purchase of your life, right? So you want everything to work like a fine-tuned machine. But I do see that a lot. A lot of people would just like go on the listing and then they'll call the listing agent that's on the listing. Yeah. And one thing you need to know is that they do not work for you, right? Yeah. That is not their first obligation. So some food for thought there too.
Yeah, there's a listing agent and then there's a buying agent. The listing agent works for the seller.
Correct.
They're trying to get them the most money and the best situation. So when you go to, buy that house, if you're working with that listing agent, you're working for their side. It's like going into to court and saying, "Hey, can the prosecution also represent me?" It's like you wouldn't do that.
No, no, you would not. No, you would not. And there are laws in place to make sure that that doesn't happen. But at the same time, the human aspect of it is always a thing.
We all know the reality of it. I
Exactly.
mean, yes, a person can be a dual agent,
Hmm.
and some of them do it very successfully.
Hmm.
It's just that, what I always recommend is that you just have your own agent.
Your team.
That is exactly. You
Your team.
build your own team.
Hmm.
That's
100%.
that's what you want to do.
100%. Okay. So the last thing I want to talk to you about is kind of the current state of just like the macro economy in America. There's so much talk with increasing mortgage rates. There's so much talk with everything that's going on right now, the current state of things. And we kind of touched on this earlier that real estate's recession proof. But would you allow increasing rates? If you're a prospective home buyer, would you allow increasing rates and decreasing affordability? I say decreasing affordability with quotes. Would you allow that to stop you from moving into your home buying venture?
Absolutely not. Um, Again, everything is relative. It's so hard to predict the future, and that's why people usually get frozen into doing nothing.
Mm-hmm.
That's kind of the situation that people were in back in 2008. Just because there's so much uncertainty, they just freeze. They do nothing. But when the rates go up, like they have, this year, um, the people that buy their house, they're still going to continue to get that appreciation that grows over time. And then you know what always happens?
What?
At some point the rates come back down.
Yeah.
It's just a cycle. I've seen it many times over my 20 years in
Mm-hmm.
the industry, but it's a cycle. And when the rates come back down, you have the house that you want, and now you have an even better monthly payment on the house. So it makes more sense to just get the house that you want when you can. Matter of fact, the people that buy houses during these times, usually because other people are afraid, get the house they want. You're not fighting everybody else. In 2020 and 21, there would be 10, 11, 12, 15 offers
On one
on
house.
one house.
Mm-hmm.
One house, right? So anyway, the rates go up. So now instead of 10, 15, 20 offers, maybe there's 3.
Mm-hmm.
Okay? You have a lot better chance of getting your house when the rates are higher than you do when they're lower because everybody can buy.
Right.
Take advantage.
It's like a game of Monopoly. You're not making any money just collecting 200 every time you pass go.
No.
You're not making any money. If you really want to make money, if you really want to get into the game, then you have to at some point buy something.
Right. You do have to buy
You have to buy
something.
something.
Did you want me to finish the process of buying?
Yes. Yes.
Okay.
Please do. Because I
So
want you to end with me selling my house. So please. Yeah. Yeah.
okay. So after we do the pre-approval and everything,
Uh-huh.
so we get Cam a pre-approval letter. Say
Mhm.
this buyer is good to go. They can buy something.
Mhm.
So then you take them out. You find them their dream house. Write a contract, and then after they have the contract, everything comes back to me. We re-verify all their information again. We do a background check on everybody involved, right? So like, hopefully there's no felonious or criminal activity going on with anybody
Right.
because that's when it'll come up. But assuming that doesn't happen, we get an appraisal so we can make sure that you're not overpaying for your house,
Mhm.
right? And then after that, we send it all to an underwriter who checks out everything, make sure all of our documentation is correct. And assuming it's good, you're sitting at a closing and somebody's signing off on their mortgage and they own their house. So
Happy times. Everybody's smiling, taking pictures. Put them on
correct.
MySpace, right?
That's right. Put them on MySpace. Put them on MySpace.
That was a dig. I don't know
Follow
if
follow
did
me on
you-
Facebook. No, I
Okay.
definitely got it, but I was
Okay.
just trying to roll over that because
Okay.
I understand I'm old. I get it. I get it. I get it. I get it.
No, man. No, man. Okay. Cool.
Yeah.
Anything else that you kind of wanted to cover before we wrap up here?
I think we talked about the relationship part,
Uh-huh.
but I just wanted to say that when you find somebody, like if you have a good realtor, work with their network.
Mm-hmm.
That is so important to have that continuity because a realtor will usually have not only a mortgage professional, they'll also have a title company. all of those things make your process a lot smoother.
Mm-hmm.
If the realtor and the mortgage professional are doing things correctly, basically you're only giving them documents during the process.
Yep.
Besides that, it should be smooth sailing.
Mm-hmm.
So
Yep. I just recently I'm working with someone kind of outside of my network, a lender outside of my network, and we're dealing with something as simple as getting the address on the pre-approval letter.
right.
And it took like 6 days. It was such a headache just because it was outside of their system, but it was something that the sellers required.
It sounds like you're working with one of those national
Yeah.
companies, because that's what happens, man. Vet who you work with. I can't stress that enough. Make sure that you're working with a bank that also is invested in your community.
Mm.
And a lot of the nationals, you're just a number.
Mm-hmm.
I get a lot of clients from those places because it's like they'll be working with a realtor like you, and they'll get stonewalled at some point, and then they'll come to me like, so. I tried to tell them to come to you in the first place. They wanted to go with XYZ company,
Mm-hmm.
and this is a disaster. We keep getting moved from person to person.
Mm-hmm.
We don't even know who our contact is. And next
And
thing
you're
you
dealing
know,
with sensitive information. You're dealing with your social security number.
Yeah.
You're dealing with your bank account statements, all
Yeah.
that stuff. So
Yeah.
food for thought.
Yeah.
Another thing. Well, first off, how can everybody get in touch with you?
so you can like me on Twitter. I'm not on Twitter. I'm
I was about to
I'm
be
not on
surprised.
social media at all. I don't.
Okay.
No. You can post my phone number and email address.
Okay.
I am very old school. I don't advertise. I don't put anything on social media. But that's just because I've been fortunate enough to have really good relationships all these years. So all the people that work with me are just directly by referral. I have clients that liked the work that I did for them, or realtors that liked the work I did, and just bring more people to me. So we've been very fortunate. Myself and my team, they do great work, and we just keep everybody happy.
For sure. Love that. Love that. And then one thing I did want to talk about before we completely wrap up, we're going to put a graphic up on the screen. And basically, this is just going to show everything that we've been talking about. So it's going to show a house that was purchased in like the 90s, was it?
Right, 93.
93.
Right, 93.
And then it's going to show all the way at the top, every single time it was sold, the person who sold it made money. Every single time. Through 2008, through the .com bubble, through everything. Yeah. Every single time it was sold, the person made money. So we're going to put that up. Check that out. Other than that, thank you again for joining. Once more, my name is Cameron Gunnels. Love y'all.